Hello everyone, welcome to Optiongig. This is your host Vivek Somani. I am an option trader by passion and a full-time software executive by profession. If you want to learn how to generate consistent monthly income trading options while working full-time in your day job, then join me in this journey. The topic for today's discussion is cash secured put. So this is one of the basic strategies which I call it as a transition strategy because mostly the newbie option traders, they use this strategy, and this is one of the two strategies that I would suggest to somebody who has been doing stock trading but would want to do options trading. So we'll discover what this strategy is about. So before we jump into the strategy, let's first understand what is a newbie option trader profile. A newbie option trader could be the one who has a cash and wants to invest in the market. That person has been comfortable in buying shares from the market at market price. Most of the people who just do stock investment, that's what they do. Or a newbie trader could be the one who already has the shares. Maybe they bought it through inheritance. Maybe they had the shares through their company stock options. Or maybe they bought it earlier from the market and are still holding it in their portfolio. These are the people who are comfortable in dealing with stocks but have never dealt with option. So they are newbie to the overall option trading scenario. Or it could be both, combination of both. Alright, today we're gonna cover what is an option strategy for a newbie trader who has money to invest. It means they have a cash and they want to buy the shares. 99% of retail investors do exactly the same. They got money, maybe lottery, maybe they got some extra bonus, go and buy the shares from the market. So now we look at stock traders who have money and want to buy the shares. What other options do they have to buy the shares? Is there a better way than just to buy the shares from the market? Here comes, that's where the cash secured put is important. This is one of the basic option trading strategy which allows traders to buy the shares. So instead of buying the shares outright from market, it is better to sell a put option. Why? Because when you sell a put option, you can determine what stock price at which you are comfortable owning the stock. And you choose the time period of how long are you willing to wait for the stock to be given to you at that particular price. And for this waiting, you collect a premium money. Again, I want to break it down into very simple terms. Instead of going and buying the stock from the market, it is better to sell a put at the strike price at which you are willing to buy the stock. It could be the current market price or it could be the nearest at the money price. You determine the time period for how long you're going to wait. You're comfortable waiting for the stock, and that will become your expiration date. And then you collect the premium for waiting. So we will see in next few slides an example of a cash secured put. Then we will also consider what are the different scenarios and how that cash secured put plays out. So what's the advantage of selling a cash secured put? The advantage is that the cost basis of a share will be less than outright buying the shares because you collected money, you received premium to wait, so that immediately reduces your cost basis if you get assigned the shares at the price at which you are anyway comfortable in buying the shares. Let's look at an example. Let's say I want to acquire 100 shares of AMD because I am bullish on AMD. If I'm just a stock trader, I'll go to the market, look at the market price, which is currently $18.60. I might spend $1,860 and buy 100 shares of AMD. But instead of doing that, I would rather check what is the nearest at the money put which is available, and I'm looking at and find that 21st December put for $19 strike price is selling for $2.10. That means if I sell one AMD contract expiring on 21st December at a strike price of 19, I will be receiving $2.10. So by waiting till 21st December, I'll be able to reduce my cost of acquisition of AMD shares by $2.10. So the real cost of acquiring each share will be $19 minus the premium received, which is $16.90. Okay. Now in the next slides, let's look at the different scenarios of what may happen in the market. AMD may go up, AMD may go down. Today it was October 26th. My option is expiring on 21st December. In between, things could happen. And let's look at the different scenarios. First scenario is that AMD jumps higher, that it jumps by 7.5%. So in that case, the share price of $20, that will become $20 and is above the strike price of $19. So I will not be assigned the shares because I sold a put. Put was sold for $19. Market by the expiration time, the share price is actually $20, means this 80, the short put is out the money and it will not be assigned. So net result, I will retain the $2.10. So even without getting any shares assigned, I've earned $210 just for waiting. And if I'm still bullish, if I think this AMD could go even higher, I would go ahead and sell another put option and continue it. Let's look at another scenario, which is it goes down by 7.5%. Means in the previous one we looked at where it jumps up by 7.5%. Now we're looking at that it goes down by 7.5%. In that case, the new share price would be $17.20 at the expiration time, which is below the strike price of 90. So now the put option that I sold is in the money and I will be assigned those shares. So we'll be put those shares at $19. But since it took a premium during the trade opening, the cost basis is $16.90. So even though the share or the AMD stock went down by 7.5%, it went down by $1.40, you are still in profit of 30 cents. Contrast it with the scenario where you would have bought the share outright from the market at $18.60. It went down by 7.5%. You would be losing 7.5%, or you would be losing $1.40 per share. But in this case, even the shares went down, you're still in profit. Why? Because selling put gives you that buffer. The premium that you received by selling the put gives you a buffer in case the share goes down. Let's look at the third scenario, that the share price is exactly the same as the strike price. So nothing happens on December 21st. You retain $2.10 and that is 11% return on your investment. And in your margin account, your actual return on capital will be even higher because in a margin account, the amount of capital blocked is only 50%. In some cases, it is even lesser. So your return on capital is even enhanced. So we looked at the scenarios where the stock could go up, stock could go down, and the stock could remain the same. And we looked at how the cash secured put is a better strategy than to buy the stock outright from the market. Alright, so selling a put is a share acquisition strategy. Mind you, we are considering the profile of a newbie trader who is comfortable in buying the shares from the market. But instead of buying the shares from the market, the other way to acquire the share is to sell the put. So I consider this as a share acquisition strategy. It reduces the cost basis of the share by the amount of premium that is collected at the trade opening. I also refer this strategy as a transition strategy because it helps in transitioning from just being a stock trader to an option trader. This is the strategy where a newbie option trader can dip their toes, try to understand how the options work, how the options change, and to be comfortable with the whole idea of option trading, but still retaining their outlook and the profile of a normal stock trader, that is, acquire the stock, hold it. So instead of acquiring the stock from market, selling a cash secured put is just another way, or another, I would say, a more capital efficient method to acquire the stock. Alright, with this we come to an end of this session. Thank you for your time. If you have any questions, please write it in comments or email it to optiongig@gmail.com. If you liked what you learned, please help us spread the word so others can also benefit from it.